So in this video, I'm gonna give you what 17 internships on Wall Street will not give you as information about investing in terms of value. A lot of people, especially on Instagram, kept asking me different questions about valuations of company, investing, hedging. So I decided to just put up some information over here without preparation, everything that I believe it's a very good starting point for everyone to understand and make up the difference. There are three main general concepts about investing. Then we're gonna niche down of each of these concepts, and I'm gonna give you things that simply don't exist in the textbooks. The first general concept on the markets is that the hope and the plan are not the same thing. There are investors that you probably heard that are called sophisticated investors. They operate under a specific plan. Every investment, when they're gonna buy, when they're gonna sell, when the price action will go leg up, second leg up, third leg up, comes by particular plan. This plan is always backed by predictions, estimates. Every single move on the market, every time when they actually change their portfolio, it is always based on particular move, steps, inflows and outflows of the particular asset. The people who are not sophisticated on the market are basing each and every investment on hope. These are the people who were buying in 2019 NFTs for $15,000. These are the people who were betting in 2022 on meme coins. A lot of people simply cannot pronounce the name of the meme coin, but they were buying it. A lot of people bought the wrong coin because they were thinking they're buying the right one. So the plan and the hope are not the same thing. This is why a lot of people are seeing substantial difference in returns. Even when the bear market hits, in 2022, Wall Street, big 6 or 7 firms lost on average around 12 to 15 billion dollars this year, unrealized losses, right? Retail investors also lost a bunch of money, but the sizable chunk of losses were essentially coming from individual investors, people who are not sophisticated, people who are buying every single dip, hoping that the market will reverse, while Wall Street, some of the positions were essentially downsized. They took some losses, they shift capital, allocate from this losing position to other position. They might lose some more on the next one, but unless they don't stuck with the losers, they still have some chance to recoup the losses, break even, or make some profit on some of the other positions on the side. So, rule number one, plan and hope are not the same thing. You need to choose who or what type of investor are you. You can learn everything by yourself. Like I said, 17 internships on Wall Street will not teach you this because each and every firm will train you to operate under a particular framework that the company is working on the market. They're not going to teach you what the other 17 firms are working. And for you to be able to actually sort out the working versus non-working strategies, you need to see all of them or you need to experience all of them. The second main general rule on the market is that concentration versus hedging or diversification is not what it used to be. Even Warren Buffett, who speaks a lot about diversification or effectively making multiple different bets that are equally spread within your portfolio or position sizing, allowing you to make mistakes and at some point you can exit at least at break-even point. The funny part is that Berkshire Hathaway, the company that he was managing for the last 6 years, usually had between 8 to 10, sometimes 11 to 12 maximum stocks in their portfolio. This illustrates that they genuinely didn't believe in diversification because they were very heavily concentrated on particular stocks. And the idea is very clear. If you're very good in what you do, if you are very good in analyzing companies, if you're very good in making prediction of particular price action, particular move, there is an industry evolvement like the AI right now. Let's say you catch up with this, you make your big bets in 2018 or 19, and you have been waiting for this moment because you saw it coming, right? You don't really have to hedge your position. And this is what, Buffett's portfolio illustrates. When you diversify or when you over diversify, you cannot really capitalize to the maximum extent, right? If you have $1,000 and you buy 10 stocks, you can only put $100 each stock. Sure, your risks are much lower, but your upside also is much lower because the velocity of $100 how many times $100 have to roll over 100%, 100%, 100% return for you to be able to make at least $10,000? Versus if you just put the, let's say, the $1,000 into two companies, $500 each, you make 100%, you already have $100,000. You already have $1,000 in your portfolio on the one position, right? It's a huge difference. So rule number 2, you have to choose: are you a generalist? Diversification is your priority, or you have a concentrated bet on the market, meaning that you're very sophisticated in the research and development, you're very sophisticated in analyzing and filtering companies, and you understand the trends. Third important element over here: almost every big bet on the market from Wall Street is not meant to be self-fulfilling. Wall Street operates in ratios with leverage. For every $1 that they have under management, money invested from their investors, they have $5 borrowed against this dollar so you can leverage the position in portfolio. One of the biggest investments on the market happen through fast risk taking. And fast risk taking from Wall Street means risking someone else's money. As an individual investor, you cannot do that, because if you have $1,000 and if you risk $1,000, you lose everything, right? You have to go and start over, and you probably have to work another week or 2 weeks or 3 weeks to recoup this initial invested capital. Wall Street do not really care, because they make money on the 1% original fee when everyone invests with them, and then they make additional 20-30% based on the return for the year. So Wall Street do not really operate within the same constraints. So the third general rule over here, you have to choose: are you a risk taker or are you a risk maker? Are you the one who is willing really to put up the time and work and really back his bets to the fullest extent, or you have plenty of time ahead of you, you're not really looking for big risk exposure, and you're okay with making small wins here and there? So always choose your fights. Everyone wants to be rich or wealthy at some point, but they do not see getting there in the same way. A lot of people keep taking 100% of their portfolio, especially people who trade in forex, individual investors. For them, you probably seen this $1 to $1 million challenges. For them to at least be on the right path of achieving that, the simple math illustrates that every single time they have to bet 100%. So you start with $100, you have to bet 100. Then let's say you make 100%, you have $200, and you have to bet 200, right? So every following bet is a max out portfolio. So only one loss, only one wrong move, and you completely wiped out. When you understand these concepts, you understand that it may look like that you, as an individual investor in Wall Street, as institutional investors, you guys operate or play in the same ball field, right? You're trying to play with the same ball, but as I illustrate you, they don't really operate under the same framework. They don't really have only 11 players, and if something goes wrong, they can always put up new players. They can always come up with new money. They can always come up with new strategy. Protection of Federal Reserve will save them and will bail them out. This happened many times over. It has happened with banks. It has happened with hedge funds. It has happened with family offices. It has happened with insurance companies, right? Just follow up all the different financial crises that we have or turmoils. So you need to understand, people who are not in the position of Wall Street, having all the resources and tools and trying to trade or invest like Wall Street, are going to lose. Remember, your own advantage over them is that you can pull your own strings. You don't have to make reports to your investors. You don't have to check back. You don't have to run financial models. You don't have to run different simulations on particular trade to make sure that you're not going to lose someone else's money. That's your biggest advantage. You're flexible. You don't have to submit filings, what you bought, what you sold. You need to identify where you're actually overtaking Wall Street, where you have the biggest advantage, and how you can utilize your advantage. Don't try to play their game against them and their tools and their advantages in a game in which the money is the ball, and they have more money than you, and they will always have more money than you. That's, I believe it's a good starting point. We can niche down, but it's already 10 minutes past. You might actually start glitching at this point. So rewatch this video a couple of times, take some notes, and think about it.